I'm a law partner at Waller & Mitchell in Newport Richey, Florida, and I wanted to speak to you this afternoon for a minute or two about capital gains taxation. The capital gains tax is a tax that's levied on the sale of appreciated assets, basically on the profit that you make when you sell. There are two types of capital gains, short-term and long-term. Short-term are for assets held less than a year. Those get taxed as ordinary income. Long-term capital gains are those held more than a year. They get taxed at a special rate somewhere between 10 and 15% depending on your other income. So exactly what can be a capital asset that's subject to the tax? Pretty much anything other than something you hold in inventory in your business or as stock and trade. So even cars and personal effects in your house are technically capital assets that could be subject to the tax. Of course, nobody keeps any records on those kind of things, so very seldom do we see that unless you have a very expensive painting or something with documentation. But the most common things that we talk about are stocks, bonds, mutual funds, and real estate. Now, real estate includes your personal residence. However, there is a specific exemption in the law for personal residences for a married couple of gain of less than $500 and for $500,000 and for a single person gain of less than $250,000. But that's a single exemption that's specific to the Internal Revenue Code. So what happens in a capital gain transaction? How do they compute the tax? Well, they take the purchase price that you paid for the property to start with, and they call that basis in the tax trade, and they add to the basis any structural improvements that you may have made to the property, and then when you sell it, they subtract that from the selling price to come up with the gain. Then they apply the 15% tax rate to the gain to get you the tax. So let's take an example. You buy a vacation home up in North Carolina and you pay $100,000 for it. The next year you put a deck on the back of the property. The deck's worth $10,000. So you've got $110,000 invested in the property. In 2012, more than 1 year later, you sell the property for $210,000. So your gain is the $210,000 minus the $110,000 or $100,000, and the tax due on that transaction at the 15% rate is $15,000. So if you have any questions about capital gains tax or any other tax issues, give me a call. This is Tom Mitchell at Waller & Mitchell. My telephone number is 727-847-2288.